Buongiorno, siamo con Matthew Duda, principal di Pramerica. Matthew, what do you think Fed and the impact of possible rise of interest rates in the next month?
Well, it's a very good question. U.S. economic data, certainly over the course of the last few months, has been solid, not too strong, not too weak. I think given recent numbers out of the United States as well as external conditions, our expectations are that the Fed will increase the benchmark overnight rate by 25 basis points in September, and will follow on the increase with a very detailed communication as to why it is increasing interest rates and its expectations for monetary policy in conjunction with U.S. economic growth, inflation expectations, wage growth, etc., over the course of the next year in its press conference. That being said, we do not see U.S. economic conditions as warranting significant increases in the overnight rate over the next year or two. So that being said, and a Fed that is going to be very measured and very explicit in terms of communicating its expectations for its forward expectations for the U.S. economy, we don't see a major effect on emerging market bonds based on the Fed increasing interest rates. An interesting thing to note also is if you go back and look at periods of Fed hikes back to 1994, emerging market debt, and in particular emerging market hard currency debt, has performed extremely well in the three periods cumulatively following the increase of interest rates by the Federal Reserve. So obviously history doesn't always repeat itself, but in this case the emerging market countries in terms of valuations are in a good spot. The market is expecting, we think, a slight increase in interest rates, and for that reason we expect emerging markets to perform well over the course of the next year.
So what about the currency, and so how to cover the currency risk by balancing investments in hard and local currencies?
Right, that's a great question, and certainly we've all been watchers of the currency volatility that we've seen in emerging markets over the last year or so, and it's been extremely difficult to trade and extremely difficult to discern any real patterns or trends in emerging market currencies relative to the dollar, for example, over the last year or so. So I think until we have more clarity on economic conditions in the Eurozone, for example, which appears to be doing a little bit better, more clarity on the situation in Greece in terms of reaching an agreement with its creditors and having a long-term solution to its issues, more clarity on the Chinese slowdown in terms of economic growth. The U.S. growth engine alone is significant in terms of providing stimulus to the rest of the world. I think until we get more clarity, though, again, on the rest of the world and growth trends, it's going to be extremely volatile on a country-by-country basis in terms of exchange rates in emerging markets. That's the case because in many instances, emerging market governments have a very strong balance sheet in terms of its obligations to the external debt markets, which is why sovereign debt or dollar-denominated external debt has performed very well. But to remain competitive in a world of still slower growth, many emerging market countries have allowed their currencies to depreciate to stay competitive, particularly on the export side. And for this reason, and in conjunction with still slower global growth, we would expect volatility to remain there. So in terms of emerging market currencies, there are some that we think offer some compelling value relative to the dollar. Brazil, for example, right now we think is attractive. Indonesia, we think is attractive, but they're few and far between. And we think right now you stay close to home in terms of taking outright FX risk in emerging markets, focus on some of the stronger countries, two of which I just mentioned, and focus your allocations to spread risk, and particularly in dollar-denominated external debt in the short term.
And how to control the volatility in the markets? Is it a problem now?
It's a very good question, and I think when you talk about volatility, you can talk about volatility from all sorts of areas. FX volatility, interest rate volatility, duration, etc. So I think in a very uncertain world right now, you stay close to home in terms of overall interest rate risk or duration risk, for example, in a hard currency bond portfolio. You limit your outright exposure to emerging market currencies, focusing on maybe a couple, three stories that have very idiosyncratic sort of properties, where you can maybe understand an underlying trend from a position of relative weakness. I talked about that beforehand, and take outright hedged exposure in local currency denominated government bonds in emerging markets. So that being said, stay close to home in terms of duration. Focus on idiosyncratic credit stories in the dollar-denominated space, or in the corporate space, even in the short end of the maturity spectrum, and wait for longer-term or broader trends to emerge in conjunction with growth in the Eurozone, China, etc. over the near term.
Let's talk about emerging markets. Which are the sector and countries most interesting?
Right. You know, we had quite a move last year in commodity exporters. Certainly in the third and fourth quarter of last year, with copper prices declining dramatically, oil prices declining dramatically, iron ore prices dropping dramatically. Many of the countries that are major exporters of those commodities were hurt considerably. We saw the sell-off in Russian assets, in Brazilian assets, in Colombian assets, even in Mexican assets, for example, which is thought a lot about as a big oil exporter, but in reality really isn't, but does produce a lot of oils. So commodity-based sorts of countries suffered dramatically in 2014 and the beginning of 2015. Assets from those countries are still pretty attractive relative to where they were during the summer of last year, before commodity prices fell dramatically. And while they have recovered a bit with commodity prices over the last month or so, we still think offer a lot of value. So again, countries like Brazil, Indonesia, Mexico, even Russia, shorter duration assets offer a lot of value in this environment right now. So we'd look to take advantage of some of those opportunities in beaten up countries from a commodity producing standpoint.